Hi, everyone. Welcome to the Timing Research Show for September 19th, 2016. Today we will be talking about the 156th report from Timing Research. So that's 3 years of these reports that I've been doing. So if you'd like to download this or any of the past reports, just go to TimingResearch.com and you can find all of them there. I have Dean Jenkins of FollowMeTrades.com hosting today, so I'm going to go ahead and turn it over to him.
All right. Well, thanks, David. Thanks for having me here. Been on the show several times, and I always look forward to it. I always learn something. And today is my first time as the moderator, so I'm looking forward to that. Hope I don't screw it up. So today we've got a great panel, and again, I always enjoy just hearing from the other experts. You know, we got decades of experience just around the virtual table here. We've got Andrew Keene of AlphaShark.com, Adam Johnson of BullseyeBrief.com, Gary Dean, you got to love that last name, of SentimentTiming.com, Neil Batho of TraderReview.net, and of course me, Dean Jenkins of FollowMeTrades.com. So great way to kick it off here, just have each of the guests introduce themselves and just talk about what you do. You know, what your site's about, what your focus is on, maybe something interesting about you, and we'll just keep that order. So Andrew, we'll just kick it off with you.
Yeah, Andrew Keene. I was a floor trader at the Chicago Board Options Exchange for 10 years as a market maker. I launched my company about 4.5 years ago. We run a live trading room where subscribers can pay money to watch me trade throughout the course of the day, and our 3 other moderators. We have 4 moderators total. We have 2 future traders, and then I focus on equity options and unusual option activity. We also have 14 educational courses on demand and DVD, and I've written 2 books and 3 ebooks on trading.
All right. Thank you, Andrew. And Adam Johnson.
Thanks, Dean. And I'd like to note I've actually written, I don't know, Andrew, what should we call it? An endorsement, not a preface, but of your book. It's really good. So if anyone hasn't read Andrew's book, come on, go out and get it.
Wait, what is it? On the back of the book, I don't know what it's called, though. It's an endorsement, isn't it?
I don't know. It's an endorsement.
Yeah, endorsement.
It is extremely good, and I say that speaking as a guy who traded options for a long time. I was a Wall Street person who never intended to go to television. I ended up on Bloomberg television for 5.5, 6 years. Andrew and I used to go on air quite a bit of time. And I left Bloomberg over a year ago to launch my own business, BullseyeBrief.com. And it's, as I tell people, the 3 ideas most worthy of your time every 2 weeks. I'm going to get into some of the picks I just picked over I just published over the past weekend. Absolutely love what I do. It's all grounded in data. It's thematic. It's top down. I tell you, here's what's happening. Here's why. Let's interpret it. Run the numbers on the Bloomberg. Figure out exactly how we play this thing. And then I give you a very specific set of trades and parameters. So I try to lead you from start to finish and tell you a story.
Great. Thanks, Adam. I love you said this, you love what you do. This is the best job I ever had. I'm having a ball. This is fun. Gary Dean.
How you doing? Well, I run actually two separate websites. One is Markets Path, which I've had for going on since 2004. And over the past couple of years, I started Sentiment Timing with Woody Dorsey, and I really became partners with him after I read his book, and I've been following him for a really long time. And he's really one of the pioneers of investor sentiment and trader psychology. And each week we basically give where sentiment is. Did it hit any extremes? Where's the moving average? And he's one of the few that really people that track and chart sentiment, and through that they go through cycles, and we predict when low dates are coming and when high dates are coming, and it's been working out pretty well so far. So we're happy to be here again. I've done this a few times with you guys.
Yeah, good to have you here, Gary. And I totally agree that I think sentiment runs in cycles. I'll talk more. I'm an Elliott wave guy, and that's based on sentiment cycles as well to a large degree. All right, Neil.
Okay, nice to be back on the show. So I run Trader Review, and I used to be a broker at a major firm, and realized that when they train you in the training, they send you off for a couple weeks to headquarters. I realized what was happening was that they're really just teaching you to gather assets and hold those assets in your account. And that was really not something I was interested in. I was more the financial analyst where I'm thinking, I want to make these guys money. You know, the best picks at the best time. I want to get out. I want to get back in at the right time. And that was not their thing. Their thing was to hold everything in your account. And the big thing was, how much money do you have under management? That was always the thing. And I'm going to tell you guys something. If you meet with a broker, their card will say something like Executive Vice President of Investments. The only thing that means is how much money is in their accounts. It has nothing to do with how good they are at actually managing the money. But anyway, I learned a ton when I was there. Series 7, the whole thing was an awesome time. But now I did a seminar with a few other brokers on point and figure charting. And they called these guys, the point and figure guys. And it was right before I quit. A couple years later, I said, I'm just going to start my own site. I learned point and figure charting. I think I'm one of the best in the world at it now. There are types of indicators you can use in point and figure that you cannot get anywhere else. The bullish percent is one of them. Basically, if this thing reverses, you are not going to be long the market overall. Many other indicators. And I send out detailed technical picks to all my subscribers.
All right. Thanks, Neil. I love executive vice president based on how much of other people's money you have in your.
You could be losing 10% a year. It doesn't matter. If you're bringing in 20% more money.
I talked to a lot of my friends who ask about my business, and they're they have financial advisors, and if you press hard on that, it's like they want to be measured on well, I didn't lose as much as the rest of the market. Right? And that's not success in my ledger there.
I have to say one last thing. I have to say one quick thing though about brokers is the one thing they will help you with is they will not sell at the very bottom. Because they'll convince you to keep holding, and when you are so desperate at the end and you're calling, you say, sell it all today. They will convince you not to sell. And that is one thing that they will help you with, because people tend to watch as it goes down and down and down. And at least at the very bottom, they'll say, come on, man, just hold. And they can't help you with that. So I had to say that. I had to say that.
There's a silver lining in every cloud. Right?
A little bit. I mean, if you hold a stock and it's up 1,000%, they're going to say, no, keep holding, But the opposite is they should have sold then, but they will help you out at the bottom from time to time. They'll say, come on, just hope for the best. And it works out a lot of the time.
All right, thanks. So I'm Dean Jenkins of FollowMeTrades.com. I founded that business just a year ago, and it's gone by really, really fast, and it's been a ton of fun. I've been trading and investing for over 20 years, and I spent most of that, about the first 15 years, as a fundamental trader. I got an MBA and worked in several big companies in the tech field, and I just thought for sure I could read their statements and analyze their products and their management and figure out which way the stock was going to go. And after 15 years, I said, there's got to be a better way. I got involved in technical analysis, and now that's, I think the fundamental information absolutely matters, but what really matters is the reality of the markets and how, the collective market is responding to all that information. And it's surprising to me. I use primarily Elliott Wave, some Dow theory. I use Ichimoku Cloud all together, and how often these tools predict, based on cycles, where price is going to go. So I offer a stock advisory service, education service. I got a live trading room, and that's what I do. And I'd say that's the best job I ever had. I'm having a great time, and we're making, we're winning. We're making good money regardless of the market conditions. So on page 1 of the report, there's 2 questions. We'll just answer the first 2 questions together, and that is, the first 2 questions are, what direction do you think the S&P 500 index will move from Monday's open, today's open, until Friday's close? And then the second is, what's your confidence in that answer? We'll go through the whole list here, and then we'll come back and ask you to justify that answer, and you can show charts at that time if you want to. But the first is what directions it's going this week, S&P 500, and what's your confidence on that? So we'll go ahead and start again with Andrew.
I will say lower. I really, when I've been on the show as many times as I have, I'm never really over like a 60% confidence. So I just think that we had a nice little rally today. We were up in the S&P over 14 points, and now we're getting sold. We're almost unchanged on the day. So I would say down, and I will say 57%.
57. That sounds like
it's 60, but it's more than 55. So I had 57.
Mathematically derived, right? You got some equation you worked on that one, right?
Well, I don't think it's 60, and I think it's above 55. So 50, maybe 57 and a half. How about that?
There we go. Perfect. 57 and a half going down. All right.
Dean, that makes it hard for the over-under guys, because they're like, you already took it away from me.
Yeah.
So,
well, I hope we get a little. I hope you're not all in agreement. We get a little debate going here.
Well, I'll tell you what. I'll take the other side of that, and Andrew, I'll tell you why. Actually, with the point and figure, chime in at some point on those charts. But here's why. Last week, we saw the percent of stocks in the S&P 500 above their 20-day moving average fall to like 14%. In other words, 86% of the stocks were below their 20-day moving average.
Yeah.
You don't see that very often. If you go back over the past year, there are really only a handful of days, and by handful I mean like 4 or 5. And we tended to get a bounce. It just got oversold. So if you ask me what I think this week, we're getting a little bounce. I will also tell you that my 2 winningest positions over the past 6 weeks have been short gold miners via various puts, puts on the GDX, puts on the GDXJ, selling calls on Kerr Mining, which was up like 570%. It was stupid. Versus gold only up 27%. And then SPX puts. I wrote over the weekend. I've made a lot of money on SPX puts. I intend to maintain that position. I may trade around it in this kind of volatility. If you're up 15, 20 handles, you got to add some more. If you're down 15 or 20, you got to take some off. Trade around the core position. But I fundamentally don't like stocks right now, especially as Donald Trump does better in the polls because he's just such an unknown, and I think the risk-reward is asymmetric against him. If he wins, I think that creates some real problems for markets just because, we don't know what could happen.
Buy coal stocks.
Pardon?
I'm sorry I interrupted.
What?
Buy coal stocks if Trump wins.
Yeah.
Sorry to interrupt.
Right. And sell them if she does. But anyway, that's my view. I probably went on too long, but I am positive this week.
All right, thank you. So we got 1 up, 1 down. Adam, you got to break the tie here. Or no, Gary, you're the tiebreaker.
I don't know how much I'm going to be able to break this tiebreaker. I'm kind of with Andrew, and it's funny. I think the last time I did this, we were in the same type of position where it was going into a Fed meeting, and it seems like the bulls love to make a run right into the Fed meeting. But I think it's going to be lower at confidence levels. It's only about 60% because I'm kind of neutral. We were looking for a big breakdown right before it came, so that was the move right now. And I wouldn't be surprised to see a bounce, but it's we haven't really seen the panic selling that typically makes a bottom after a 50-point drop. So I'm in that neutral camp. I believe it could be lower, but I don't like as far as confidence level. It can't be more than 60% right now because you just don't. With the Fed meetings coming up, it's it's always a crapshoot as far as what the market makers are going to do with the market then.
Yeah, absolutely. That makes the predictions tougher because we got some real volatility probably coming midway.
That's really the biggest thing is you just don't know, are they going to run it into the Fed decision, and if that's the case, how much are they going to have to bring it down afterwards? And so it's one of those things that I'm never a big fan of of this week of taking any big bets on either side, because the minute that you lean one way, it seems like they switch it going to the other way. But sentiment really hasn't. We've seen it come down, but again, not something that would mark a typical low right now. So that's one of the reasons why I believe that we could be heading lower.
All right, so we got 2 down, 1 up. Neil, where are you at?
Well, this is not going to be a week to make a ton of money. That's for sure. And it's true there was not panic selling, but we do have a small break from this morning, and it's tough to say if that's going to follow through. But I'm going to go a little bit to the upside, just because there was that break, and it's not going to be an easy week. Don't look to make a ton of money this week, but a small position to the upside I think is okay.
All right, what's your confidence on that, Neil?
Yeah, maybe. Yeah, 60% or so.
Okay, so
that's why we just have a small position, really.
Yeah.
But it's a lot harder to time this move, the direction of this move, than it was to time markets going down over the last week or two. That was pretty easy to do, in my opinion, or at least pretty easy to stay in cash, because you could see the technical deterioration while the index was holding up. The technical deterioration among many stocks was deteriorating underneath, and it's only a matter of time before that's going to roll over. But now it's a tough call. But yeah, that's about it.
Okay, and so we got 2 up, 2 down. I guess I'm the tiebreaker here. It's Rich. Usually when I'm on the show, there's almost a consensus or maybe one outlier. So it's odd that we're, this split, and it's nobody's super confident about a direction either.
Yeah, I think that's it. When we have everybody at 60 and 55% as far as confidence level, it's probably as neutral as you can get from the panel.
Yeah, so I'm saying down. I'm down. I'm only at a 51% confidence. Just we got, in addition to the Fed on Wednesday, we got Bank of Japan as well, and that's going to be a big deal. Same day or earlier in the day, right? Talking about their stimulus moves or lack of moves. So I think we're heading into some real volatility. If we think back, Friday before last, when one Fed governor made a kind of an offhand comment that was a bit hawkish, right? The Dow lost almost 400 points. Everybody's watching the body language, and I think this, the drama would be to the downside, and the upside's pretty limited. So, I have my analysis, my position is that we're at the very, very end, very, very top of a very long bull market. We may put in some very incremental new highs, but there's nothing exciting left on the top, and we're going to start a correction before too long. And I think someone mentioned the presidential election. That could be the catalyst, right? There's no technical analysis for that, but the cycle of the market is right. And I think it was Mark Cuban's come out and said, if Trump wins, the market's going to absolutely crash. I think he's half right. I think regardless of who wins, the market hates uncertainty, and both candidates bring a ton of uncertainty. And I think, again, the timing is right, that we're probably right around the election is a good time for a pretty good sized correction, normal healthy part of the cycle, but a pretty good correction coming, late this year, early into next year. But this week, I'm saying down 50%. Yeah, totally.
I was one of the charts that I showed last week. It's not something to trade off of, because you don't know when it's going to actually top, but it was just a longer term view of the S&P, and there's clear, wave count wise, there's enough. There's 5 waves up, and whenever you have that, you're looking for at least a 38 to 50% retracement, and that's going from the from the 6 lows. So we've never seen that kind of drop in this market in close to 7 years. So it's I'm with you on that part of it, where it could be. I think the more points from this area is going to be to the downside than it is to the upside, even if we do make new highs.
Yep. Yeah, I agree. So now is where you defend your answer to a degree. If you want to show a chart or just dig into your reasoning about your direction for the market. And we'll just run back through the list again, starting with Andrew.
Yeah, I just think that, we see it actually, the market reversing today. It looks very weak. And I also see the VIX, which is CBOE's volatility index, up on the day. And if I look at the daily chart on the S&P 500 futures, we've rallied, from open to close 2 days, and both of those days were followed by selling pressure. And the fact today that we can't hold the bid in the market and that we look like we're going to close on the lows shows me that I think there's going to be more uncertainty and a little bit more fear out there. I mean, the market's still up this year, so I think that we can retest down to 2100, and I think we will test the open of the year, which is 2049, within the next couple months. I'm not saying the market's going to correct, something crazy, 5 or 10%, but I do think that we need, in any strong bull market, you need to get sell-offs to attract new buyers, and I think this week will be very soft.
All right. Adam.
All right. In the process of rebooting my Bloomberg, I had a beautiful chart all teed up, and Norton antivirus struck and shut me down. So I can't show you the chart, but what I really want to do is just give you a version of what I told you moments ago, and I'll just repeat it. And that is that when 86% of stocks in the S&P 500 trade through their 20-day, call it 1 month moving average, tend to get a snapback bounce. And, we saw part of it today. Not great action here in the middle of the day, but, I don't tend to trade moment to moment. Some of you guys out there are far better at that than I am. I try to take more of a view over time. I tend to be more fundamental. So for me to even point to technicals like this, admittedly, is more rare than otherwise. I don't want to ramble because I rambled the first time.
Okay, then no rambling. Gary.
My one reason that I'm that I'm thinking lower is we haven't really put in any kind of any bullish divergences on the technical front, just on a 60-minute chart, and typically you're going to see that before a low comes in, and we don't really have to go all that much further to make a new low and be able to cause that bullish divergence. But when you compare the 60-minute charts on the S&P futures and the S&P cash, we're actually starting to see bearish divergences starting to form on the futures. So it's kind of, that's one of the reasons why I'm really leaning towards we could see lower. And again, sentiment has been just popping up and down, and typically when we have those low sentiment readings and then high sentiment readings, it's usually not a good foundation for a reversal that's going to stick. So I think the downside will be the winner by the end of the week.
All right. Neil. Give us
something I've been looking at for a while here is the S&P 500 PE ratio. You have to just type it up in Google, and what you'll find is that since 2009, the S&P 500 PE was at 15, now it's at 26. And we are almost...
26. What number are you using for earnings? That's like way off. It's like 17.
Yeah, no, there's this guy, MULTPL. He does his own analysis. But I think if you look back over the last 100 years, the chart would look the same, but the numbers are a little bit different on this guy's analysis. But I think if you look at like a normal, like Bloomberg or something like that, you'll still see that it's very high historically, the S&P 500 PE.
That's true.
Wouldn't that be correct? Yeah.
Yeah.
So basically, if
trailing it's like 19, forward it's like 17, and you're absolutely right. Both of those numbers are high. The number you're using is especially high.
Yeah. Okay. Oh yeah, this is the Shiller PE also, which I think is a bit higher.
So that's an average of earnings over 10 years. It's a moving average. That's why it's so much higher, because it includes what happened in 09. Okay, got it.
Yeah, I'll go back to the normal one. Yeah, the normal one's a bit lower. But basically, we are historically basically at the top of the range, excluding the 1999 internet boom and the market crash. So basically, in the market, if things don't keep getting better, stocks go down. I mean, if a company has awesome earnings, then all of a sudden it says, "Hey, we're still doing awesome. This year is going to be exactly the same as last year." That stock is finished, man. it's over. It's way down. For years, it's going to go down. And so the market is the same. If things don't keep getting better, they have to keep getting better all the time for stocks to go up. And, you know, you could have the economy doing fine and just flatlining for years. Everyone's happy. Everyone's got a job. The market's going to be way down. And so basically that's what I'm looking at here is we're very, very high PE ratios in the S&P. And we've had this massive rally for so many years. Things have to keep getting better, and I don't necessarily see that happening. And just when you heard the Fed say, like, oh, we're almost at the perfect economy to raise rates, oh, it's going to be so great. Well, that's it. That's like your friend calls you, and he says, you got to come to this party. It's at its absolute peak. You get there, and it's not quite at the peak anymore. It's still good. And your friend says, oh, man, you should have been here before, like half an hour ago. Is that right? It's kind of like that. So we're going to trade what we can, and there's many things that are always moving. I mean, the dollar index has been moving for several days. You got gold, commodities, I mean, everything. And we'll trade everything using ETFs, leverage ETFs, whatever, stocks, options. But overall, I don't see this as being a big buy and hold type thing for the next several months.
Yeah, thank you. And I think the buy and hold folks have some painful months ahead of them, right? And their strategy will be tested. But like you said, there's plenty to trade when the market's heading down. First, it goes down a lot faster than it comes up, and so it can be really fun. You can make a lot of money. And then there's all kinds of commodities and materials and all that kind of stuff to trade that will be going up when the market goes down. So,
Dean, there are some very juicy shorts that I can't wait to talk about.
Oh yeah.
Yeah, I love shorting.
Yeah,
I love shorting more than going long.
Yeah. It's like it's like gravity, right? It's hard to go up a hill. It's really easy to go down. Is showing here. I've got the 60-minute S&P 500 E-mini futures chart up here, and I'm just showing a real quick wave count. Friday before last, when one Fed governor made some hawkish comments about a rate rise, right, and we had a huge drop, and we've had a rebound since then, a perfect Fibonacci retracement from an impulsive wave, a retracement. Now we're in a bit of a complex correction, but it still looks like it's heading down. And if we just use Fibonacci extensions from those first three moves, it gives us about a range of 2111 down to 2082 for the S&P futures market. So still quite a ways to go down. I said I use Ichimoku Cloud. Now we're up above the cloud, and it could provide some support, and it could cause this thesis about this price range to fail. But volatility from the BOJ and the FOMC meeting, it's going to take us one way or the other. Maybe incrementally higher, or maybe dramatically lower. Not a 10 or 15% correction, but 50 points on the S&P wouldn't be off the table at all, right? And so we'll just have to see how that plays out. But I'm just sticking with, this has worked. This has been accurate, good 80-85% of the time, counting waves. And when you get a clear wave count, predicting where the final wave is going to go, it continues to amaze me how accurate that ends up being. And again, it's based on sentiment, on an investor psychology and emotion. So we've got a fourth question, a special question this week, and it was, what do you think the main reasons why most traders are not successful and consistent? What could the average trader do to improve consistency? That's a great discussion topic. And so we'll just run back through the list here again and start with you, Andrew. Give your opinion on that, if you would.
I think a couple of reasons why traders are consistently not making money. I know personally, I used to be more of a gambler. So like when I would go to Vegas, I would go with $5,000, and when I was done gambling, when my $5,000 was over. So one thing that traders look at is they think that they get a bonus, or they have money, and they start trading on it, and they press their winners a little too much, and they try to double down, and you think differently with market psychology and the way the brain works on trading. So I think that's one major reason that people don't look at it as there's not going to be a trade every day, and Adam's talking about, not being that active and being swing trading, and everybody thinks differently, and that's, great, because, the brain works differently for everybody. So trying to figure out what works for you is not going to work for someone else. So I think that's one reason. And then I think another one, you just mentioned the Ichimoku cloud, is a lot of times people are always trying to short stocks as they go higher, and they try to buy them as they go lower, because everybody wants to call the top in Apple, or say they bought, Bank of America at $1, Citi at $1, whatever it was. So, basically people are not trading with the trend, and trend is your friend. And that's why I think most traders lose money in the long run.
All right. Very good. Adam.
I'm very clear when I go into a position. I may find myself left of it if it's not going my way, but I'm very clear going in as to what I'm looking for, why I'm long or short, what my target is, why that particular target exists, and what could go wrong along the way. And I find that if I'm true to that discipline, I tend to keep myself out of trouble, especially if I am also true to the notion of, a stop. In other words, I'm willing to lose so much, and then I was just plain wrong, so get out. I find I get into trouble when I'm fuzzy on any of the reasons going in, or I get fuzzier in the midst of it, and I just sort of let that sloppiness kind of intermingle with my ego, and all of a sudden I'm no longer in control of the position. And I think that happens to a lot of people. In the heat of it, you just start to get fuzzy. You always have to go back to what you expected before you got in, before you had capital on the line, and when you were still rational, and quite frankly, could have gone either long or short, because I think most of us agree we don't care if we're long or short, we just want to make money. So it's a question of what's the rational, logical thing to do, what is the data telling us, and then we'll put the position on either way.
Yeah, I really like that. One of my mantras is, I don't go into a trade without an entry price, a target price, and a stop price, right? And what we do in the trade, once we're in it, is very mechanical. There's really no decision to make, right? It happens, so there's no emotion involved. So I totally agree with what you said. Gary, what advice do you have?
I think one of the biggest reasons why people fail in this market is they're not able to control their emotions. And when you're in a position and you're say on the wrong side and you don't have a stop in place or don't know where you're going to get out, you start depending on people that come on the TV. You start depending on newsletters, and what happens is that everything you're reading and hearing is the market's going the other way, and before you know it, you're getting out and bailing out of your position. And if you were long, it's usually right at the lows, and when you're short, it's usually right at the highs. And it's one of those things. I think having your defined risk is a huge part of it, because you're not going to be right 100% of the time. And really, all of us here, we're just trying to get a trading advantage with things. And I find, following, Woody's sentiment, it really does help me out, because if I see that's just really bullish on the market and everything that you hear is bullish, and it's one of those things that always throws up a red flag, especially if the technicals are supporting that. So that I think really controlling your emotions is the number one reason why I think people fail in this market.
Yeah, I think it's huge. And you touched on risk management. That's a big part of what I teach, and be part of my answer too. It's a good thing.
A big part of it also is that people are, this market's hard enough on its own, but they're using instruments that are putting timetables on, when this market has to go lower or higher, because they're trading options, or they're trading instruments that are going to get hit by time decay. And that's, like I said, it's hard enough calling this market, because you could have a Fed governor or a central bank say something and you wake up and the market's up 30 points, and then they say something the next day and it's down 30.
Yeah.
If you put a time stream on when when it has to make the move, you're tying your hands even tighter on it. Even though when you're right, you can make a lot more money, but you're going to be wrong more than you are right. That's the thing.
Yeah. All right, Neil. What advice what have you learned along the way you would share with folks?
I'd say a lot of people, trying to say this the right way, 80% of all stocks are going to follow the overall market, okay? And 80% of your gains are going to be in the right sector, okay? So it's all about being in the right sector at the right time. The individual stock picking, that's something else. First, look at the market, then look at the sector, then look at the stocks. And a lot of people think, what am I going to trade this week? How am I going to make money this week? Every week is different. Just like on this show, I've never seen this before, where we're right in the middle, upside, downside. It's very close. I mean, this is a week where you can just say, maybe I'll take a couple of days off trading. You're not going to miss out huge on a week like this week. But there are other weeks. I mean, I've been on this show, and people say, stock's up or down this week, and I'd say down 90%, and it's huge, and you're buying puts, and you're making 100% on the puts, and you're taking second mortgage out on the house, and you're making tons of money. I mean, there's times like that also. So people have to understand it's not always the same every week, every month, but there's going to be the times where you're going to go almost all in because it looks so perfect, everything is aligning the way you want it to. So don't think to yourself that you have to trade every time as aggressively as you always do. That's it.
All right, those are good words. I remember when I very first started in day trading and trying to be a technical trader and futures, and it's unlike any other job where sometimes the harder you work, the more you lose.
Yeah.
There's just days that aren't good to trade, right? There's
one example that I use with what you're saying with the trading is, if you go to Vegas or you go to Atlantic City, you don't get comp to room when you lose. You get comp to room when you win because they want you to keep trading. It's the same thing with trading. They want the more you trade, the more you're going to have to be more perfect. Otherwise, you're going to lose.
I'll say I want to add another thing too here, and this is huge. A lot of people will see a stock, it goes up 100%, and they sit back and they go, "Oh God, why didn't I put everything into that?" Then look back on all the trades you ever made and think about the times you are so glad that you did not put everything into a trade.
Absolutely.
And the amount of joy that it will give you to think about a trade you're thinking about doing and you did not, and it goes down and you think to yourself, I'm real happy I didn't make that trade. I made the right decision. But if it's where you're thinking, okay, this is a trade I made one time, where you're thinking, I think it's going to go up, but we're just going to do a small position. Okay, you think it's going to go up, do a small position. You don't have to do a huge position every time. If you have 100 grand, you really want to buy this thing, you think it could go up, just put in $1,000. It's not that big a deal. You don't have to put in 5, 10 grand on every pick. And it really depends on your confidence level of the trade, how tight your stop is, and it's not always going to be the same. Don't put 5 grand in every pick if you have 100 grand. You don't want to do that. You have to take into account what type of stock it is, the volatility of the stock, how close your stop point is, these types of things. If you feel you have to trade, but you're not 100% as sure as you can be, just use a smaller amount, and you know what? You're still going to be happy when it goes into green. You're always going to be happy when it goes into green.
Yeah. So I think static trade size is a huge mistake that a lot of traders make. But every trade's 5 grand or 10 grand or whatever, right? So my answer to the question, what I think the main reasons traders are not successful, I think it's risk management, not having a good grip on risk management before. I think you need that before you develop your technical indicators, your trading rules, your however you're going to find picks and manage trades. I think you have to figure out how you're going to minimize loss in every single trade. I use a fixed formula for that. And every trade I go into has an entry, a stop, and a target. And the two things that I'm only willing to lose 2% of my account on any given trade. So on a 100K account, I'm never going to lose more than 2 grand on any given trade. and I just use the distance between the stop and the entry, divide it into 2,000, tells me how many shares to buy. And you can weather a pretty good string of losses at only 2% and be okay, not be badly hurt, right? And you're controlling the downside. And as part of that, I only take trades that have a potential to be 2 or 3 or 4x the amount I'm going to lose. I got a target, and I've got mathematically or technically derived targets, right? So that the math has to work on the trade that I have the potential to make more than I lose. And if I'm making 3 or 4 times the amount on my winners that I am losing on my losers, you can have a 30 or 40% win rate and be very successful, right? Be very profitable. You don't have to be right all the time. And if you're winning over 50%, you got those kind of payouts. You're going to be very profitable, very successful. So I think the number one thing for people is to get a grip, a handle on risk management and how do you manage loss. And I teach trade with a stop on every trade, so you don't get caught in an emotional loop if it goes against you. About, well, I'll wait and it'll come back, and I'll wait some more, it'll come back, and now, I can't get out. That loss is too big. You never want to be in that trap. So that's my spiel on it. So now, those are all good comments, and I think anybody listening who's new, taking notes, you basically got a pretty good book you could have gone and bought, right, on getting started in trading and some pitfalls to avoid. The next here on the agenda is to give up a pick. What's your favorite pick or one you'd want to share with the folks who are listening here? And we'll start back at the top with Andrew.
Test. Oh, sorry about that. So a trade that I'm actually not in, but we've seen institutional order flow. So what I kind of trade is I watch institutional order flow in the option market. There are about 4,200 stocks with options in them, and I just watch to see where institutional order flow is. And FedEx actually has earnings tomorrow after the bell, and we've seen institutional order flow in the UPS November 110 calls. It seems over 10,000 of these have been bought today, which is about a $1.3 million bet. In options, we never know if options are used for a speculation or a hedge. My goal is to kind of analyze, dissect it based on the chart and how the order flow comes in. And I think UPS goes higher from here. I do actually not in this trade yet because it was too hard to get in. But the November 110 calls for around $1.30, $130 per one lot. As a beginner trader, I always talk about using a 30% stop loss on your option. As an expert trader, being an intermediate trader, being a 50% stop loss. So UPS, I think, goes higher based on this unusual option activity.
All right. Yes. Adam, got a pick you'd like to share with the?
I sure do. So, Dean, I was saying that I'm excited to talk about shorts, and it's a shame that we can only give one. But I'll tell you what, I've done a fair amount of work on REITs, real estate investment traps. They're not trusts. There's nothing trustworthy about REITs right now. You've got a number of factors that are lining up against REITs. Interest rates, at some point they're going up. And by the way, they're not going up Wednesday, okay? Only up to who's sighing?
Yeah, we got an open mic here.
Whoops. I kind of did this. It's fine. I was hoping you didn't know about. I sort of stretched while you were talking, and it sounded. Sorry about that.
If you
I just kind of did a stretch, and then
no bearing on his. No bearing on his.
I like your analysis.
Okay. REITs are moving down. They have been moving down. I am advocating being short. And there are three primary reasons. Number one, rates are ultimately going up. They're not going up this week, but they are going up. That's bad for REITs because it increases the cost of borrowing. Remember, REITs finance themselves with large mortgages. Number two, a lot of the real estate that was developed, especially here in New York, but at any major city where you see all the cranes, was financed at 3 to 4% cap rates, meaning you have to, as a developer, own that property for 25 to 30 years at full occupancy to recoup your initial investment. That's bad business. We've had so much overdevelopment. That's bad for REITs. We could go on and on. The money that has been flowing into REITs, it's been the number one place for retail investors. And you know what happens when retail finally pushes in. I mean, REITs, the REIT sector has attracted more capital because of the yields, the dividend yields this year than any other by a factor of 5 to 1. Bloomberg ran the numbers. That's That's absolutely shocking. And then finally, the fourth and most powerful reason against REITs is look at what's happening in retail. 8.7% of total U.S. retail sales are now happening online. And that number keeps increasing, which means that REITs, especially mall REITs, are losing their customers, stores. That's why you saw Macy's, Kmart, Sears, even Target announce over the past 90 days, between the four of them, that they're closing over 200 stores. So there are any number of reasons to be short REITs. You can do that versus with the VNQ, which is the REIT ETF managed by Vanguard. You can do it with a number of the hotel-related stocks. You can do it with general growth properties, which is one of the mall REITs, or RATs if you prefer. Real estate investment traps. They are one group to be short.
All right. That was a pretty, you're pretty confident. That was a pretty great, solid analysis that you laid out there. So
Thank you, sir.
thank you, Adam. Yeah. Gary, what do you like right now?
I would start off with cash as a position. So I'm really not. I would not be going too crazy this week for many of the reasons that we all just spoke about. But I think just on a technical front, it looks like the spiders is just making a bear flag here, and it's going to break down. So I would probably look at SDS, which is the ultra short for the S&P, and really just put a stop right below today's low. So you're risking a little bit, if it goes the wrong way on you, and if it breaks out, there's a shot it could go up to, somewhere between the 18 or even a little bit higher than that. So it would be SDS, but like I said, I would be really, really careful. I'm not. I have a very, say, mid-range percentage as far as my confidence with the S&P going down. I think for this week, I think down the road, it will be, it will be moving lower. But right now, it's it's anybody's guess going into the Fed meeting. So SDS would be my trade.
All right, thanks. SDS. And Neil, what do you got? What do you got cooking there?
I'd be going for the upside on technology. I think it's one of the best sectors at the moment, and I think that in any type of a rising interest rate environment, technology is the one that can hold up the most because they have no debt. They're just holding cash. And I remember back in the day when I was a broker, Sun Microsystems was one of the best stocks out there to buy, hold, trade, whatever. It was just the best. And the CEO said, this is when they were raising rates in 1999, right before the market was crashing, going to crash in 2000. And he said, it doesn't even matter if we make a product. We can pay our employees forever with the cash we have in the bank. So I welcome rising interest rates.
So okay. Is that Scott McNeely?
Yep, that was the guy. And I'm
he's
like,
a very quotable guy, man. He's got the lines.
Yeah. And I mean, I'm like, what the heck? And it's part of the reason I like trading stocks, because I remember seeing Sun Microsystems had this big swing down, and I told a guy to buy it, actually. And I don't know what happened to that. I don't know what happened, whatever, but it went way up. And I thought to myself, wait a sec, I just made 20% here in a few weeks. Forget long term. And technology, you're going to have to trade it because everything follows the market in the long term, right? S&P 500 goes down. The technology sector is going to go down. It's not going to go the other way forever, maybe a little bit. So look into tech. That's a good place to be. Look for some rebounds in short-term trades, or look for, the best thing you can in tech. So I'm just going to go with the sector right now, technology.
Okay, thank you. As you said that, with tech, they don't have any debt. I worked for Intel Corporation for a long time, and I was going to business school while I was working at Intel, and we were doing all kinds of analysis on companies, and it was a revelation for me. I was like, oh, look, honey, why would they do that?
Yeah.
Apparently there's a need to for some industries, yeah. So I get your comments there. So my pick for this week is UNG, United States Natural Gas Fund. As you can see, we've had a massive, just like oil, this is tracking oil, but 3 or 4 months behind or even longer. And so the pull up we had out of oil off the bottom where it came off about 34 up to about 54, it really looks like we've got a real clear technical setup here on UNG. This is an impulsive or a corrective wave. trade. So they're never as good as Impulsive Wave, but it looks really, really good. We're, if I expand it, we're up above the Ichimoku cloud. We've got a really nice place for our stop. We got an entry up here, and we got a target. This thing retraces just up to 38.2% Fibonacci retracement. It's a 1382, so nearly double your money on this trade. It'll take several months, and there's a great option market on UNG. So I really like UNG as a corrective wave trade. That's my deal for this week. All right, well, we're getting really close to the end, so this is a point where we go around and each participant, if there's just any kind of closing thoughts and any final statement, give your website or something you got going on now you'd like folks to know about. And let's go backwards this time. Neil, we'll lead off with you, and we'll just go backwards up the list here. If you're there. Probably caught you off guard, huh? I'll jump up to Gary while Neil's figuring it out.
Well, I would, like I said, I think this week with the closing thoughts would be keep a neutral bias in your head going into the Fed meetings. And one thing that you really would want to be paying attention to would be where sentiment is. And like I said, with what he does, he's one of the few that are out there that actually give sentiment numbers and explains what they mean, with either a low or a high sentiment, and that always has to be interpreted by somebody, and he's the best at it. And the one thing we have a special going right now for people that are in this that are in the actual site here watching this is we're doing it just $74.99 for the first month. I don't know if you guys can see my screen, but I'll put if anybody wants to take up on this, they could send me an email, and that's at gary.dean@marketspath.com, and I will send you this link so you guys can join on it.
All right. Thanks, Gary. Adam, any closing comments and just anything more about your service that you'd like to wrap up with?
Yeah, thanks, Dean. I spent a ton of time over the past week going back and looking at all of my recommendations since launching Bullseye Brief, which was early in the spring. 30 recommendations, 21 of them are up money. And I don't say it to toot my own horn, but I just say it because I think it's really important to keep tabs on, how you're doing. Are you right? Are you calling it right? Interpretation is everything for guys like us. And I would welcome any of our listeners, viewers, to go to Bullseye Brief, try the 30-day trial, go through my P&L. If you like what you see, put it on. Send me your comments. Tell me what you think. I want to hear from you. I love what I do. I put a ton of work into it, and being able to connect with people means a lot. And for example, one of the stocks that I wrote up this past week, Cheniere, which is the largest LNG export facility, and by the way, the only one operating in the U.S. right now. By 2020, they'll control 9% of the global LNG market. It's an incredible situation. But I wrote that up because one of my subscribers is an Irishman living in Moscow, advising the Putin administration on strategic oil decisions. I got that name from him. And that's why I love talking to people, listening, and hearing what other people had to say, because there's stuff on their radar that I wouldn't otherwise know. So please check out bullseyebrief.com. Tell me what you think. Give me a call or send me a note. I'd love to hear from you.
Great. Thank you, Adam. Andrew.
Yeah, CEO and founder of AlphaShark.com. You can always email me at andrew@alphashark.com. We run one of the biggest live trading rooms throughout the course of the world, and we have 4 moderators running the room from 8 a.m. Central to 3:30 p.m. Central. We have full audio and visual throughout the course of the day. There's never any silent breaks or chat. We also have educational courses, and I would say take up the free trial of Adam's product, of Bullseye Briefing. I purposely never get in debates with him because he's way, way smarter than me. So just listen to what he says because he's way smarter. So that's about it. You can always email me at andrew@alphashark.com. And thanks for having me on. It's always good to be on with my buddy Adam Johnson.
All right. Yeah. Thank you, Andrew. And Neil, are you back with us, or did you drop?
He looks like he's disconnected, so he must have had some sort of computer issues.
Okay, that's too bad. So I'll wrap it up. I'm Dean Jenkins, followmetrades.com. You can go check out my website. It's got my P&L and running for about the last 4 years. So it's followmetrades.com. And I do have I'm going to be running giving a free guest pass to, we're going to do a trading room right as the FOMC minutes come out. So if you'd like to come in the room and hear the analysis and the setups I'm looking for, and just some commentary, and as the minutes drop and the market explodes one way or the other, just shoot me an email, dean@followmetrades.com, and I'll send you a guest pass and get you into the room. All right, well, that's it. And I guess back to you, David. It was fun to be here, first time moderating. Thanks for all the panelists, and David for inviting me.
Yeah, great show. Glad to have you host this week. And I just want to remind everyone watching that you can go to TimingResearch.com and download this week's or any of the past reports there. And you can also view any of the past episodes of the Timing Research Show, including this one, will be up on the site in a few minutes. So be sure to join us next week. Christian Fromhertz, Eric Wilkinson, Roy Swenson, Jim Kenny, and Matt Buckley will all be back on the show. And I just want to thank my guests again for this week. Andrew Keene of AlphaShark.com, Adam Johnson of BullseyeBrief.com, Gary Dean of SentimentTiming.com, Neil Batho of TraderReview.com, and of course, Dean Jenkins of FollowMeTrades.com. Thank you for hosting. And my name is David Kosmeter. I'm the creator of Timing Research. So thanks, guys.
Thank you, Dave.
Take care, Dave.